So, there are a lot of ways to measure a company's performance, and I imagine by now you've learned some of these tools in your finance and operations and marketing classes, but we'll review them. So, there are financial metrics, profitability, growth, and operating efficiency. Marketing metrics, I highlight a few here: relative market share, customer satisfaction, and customer acquisition rates. Operating performance metrics, quality and timeliness tend to be important in certain industries, and HR metrics, employee turnover, satisfaction, skills and capabilities assessments, what skills does your workforce currently possess, and what skills do they need to develop. We're going to look at tying these concepts all together in the form of the balanced scorecard and talk about the role of benchmarking. First, a note on using financial metrics. So we're going to focus mainly on operational performance and profitability in terms of finance ratios. We also want to minimize accounting distortions and the impact of capital structure where possible. So that is why I recommend, when you're looking at profitability, to focus on return on invested capital. Return on invested capital is equal to net operating profit after taxes less dividends divided by all the invested capital, so debt and equity, and we're taking the book value of equity here. So strategists like ROIC because it ignores the impact of a company's capital structure, where ROE is just the return on equity, so it focuses on return to shareholders and doesn't think about what debt holders may receive or what value is being generated with all the capital that's been put into a business. But we will talk about ROE because ROE is the most popular measure of financial performance, and you will see it cited just about everywhere. While I don't like ROE as kind of a top-line measure, unless I was asking you specifically about equity holders in a company, I do like the DuPont ratios. You can break ROE into three constituent parts, and these are called the DuPont ratios because someone at the DuPont Chemical Corp came up with these initially. So this is helpful because you can kind of diagnose where performance issues might be coming from or what might be driving performance by looking at the three components of ROE, asset investments. So how to approach financial analysis in the context of strategy class? I would start with ROE and the DuPont ratios. As much as I don't like ROE, start with those DuPont ratios because it gives you a basic diagnosis of where you need to delve a little further. So which of those three levers, those three components of ROE is really driving change in profitability for a company? Do we need to dig deeper into profit margins or asset efficiency or financial leverage? It gives you a starting point. Then look at profitability measures. What do the various profitability ratios tell you? How do changes in profit margins compare to changes in actual profits? So this is a good one to ask because you also want to understand if a change in profitability is due simply to increased or decreased revenues, or if it's an efficiency issue, increased or decreased costs relative to revenues. What are the trends over time? And how does the company compare to the industry as a whole? We repeat a similar process for operational efficiency ratios. So is the company managing assets efficiently? How do they compare to prior performance and industry performance? So I haven't spoken about growth yet. Year-over-year top-line growth, so sales growth or revenue growth, is especially important for companies in the growth stage of an industry life cycle. A company's growth rate can be compared against the overall industry growth rate to see if a company is gaining market share. Market share is another important metric that we look at. I give you an example here where, say, the widget industry is $1 million industry in 2004, and between 2014 and 2015, it grows 10%, and now it's a $1.1 million industry. Super Widget, which is the firm we're looking at, was a $100,000 company in 2014, so they made $100,000 in revenues. So they had 10% market share for the widget industry. But in 2015, they are a $120,000 company. So that means they grew 20% year over year. It doesn't mean their market share doubled, but you can see that 120 over that 1.1 million, they now have also grown in market share. Speaking of market share, let's now turn away from financial ratios to marketing ratios. Relative market share is one of the key metrics we look at in the strategy class because we want to understand how companies are performing relative to other players in the industry. So market share is kind of an absolute percentage. It's a percent of a total addressable market. Relative market share would be if Walmart is the largest player in the discount retailer market, the number 2 player relative market share would be reflected as if Walmart was equal to 100%. So their market share might be 80% of Walmart's market share, as opposed to, say, 10% of the overall market, if that makes sense. A couple other marketing metrics that come up on a regular basis. Customer acquisition cost is important if you're looking at a company that's trying to grow and acquire new customers. Net promoter score. I assume you've talked about these concepts in your marketing class, but there are a number of other ways to gauge customer sentiment here. I also have a picture here of the marketing funnel because different companies may be focused on a different stage in the marketing funnel, whether they're building brand awareness or trying to retain customers, kind of, once again, coincides with where they are in the industry life cycle and product life cycle. Operations metrics. So we've talked a little bit about operational efficiency, so asset turns, but for some industries it's important to have other operational metrics. So especially manufacturers tend to look at these metrics. Quality metrics, such as Lean Six Sigma metrics. In the Six Sigma system, companies aim to have only 3.4 defects per million opportunities. So for every 1 million products manufactured, if your error rate is under 6 sigmas from the mean, then you would only have 3.4 defects in that set of goods you're producing. This applies in service industries as well. You can apply Lean and Six Sigma and quality principles. You might focus on production time or time to serve a customer or other internal metrics. As Michael Porter pointed out earlier in the semester in one of the readings, efficiency isn't the same thing as strategy, but it is certainly part of performance, so these are metrics that we have to keep in mind when diagnosing the performance of a company. Finally, what I kind of call HR metrics. Employee satisfaction, employee retention. Can we keep our workers? Are they happy in their jobs? Especially in service industries or high-skill industries, having happy employees is a direct contributor to productivity. From a strategy perspective, do the workers at a firm have the capabilities they need to perform their jobs now and the jobs that we're going to be asking them to do 5 or 10 years in the future? So a word of caution on the use of metrics. A single ratio or a single metric for one period in one firm does not really say anything to us. So metrics are really only valuable if they're used for comparative analysis. So if you take the same KPI, which is KPI stands for Key Performance Indicator. It's a synonym here for a metric. So if you take the same KPI in a company across several months or years, or different KPIs in a company in the same month or year or the same period, or even take the same KPI across companies in a process we call industry benchmarking, all these give you more useful data points because you need that context in order to understand, is this a good number, is this a bad number? That's why benchmarking is a valuable activity. You have a reading very short reading about benchmarking, but I'm sure many of you are already familiar with the process. There's not a few more words of caution here. KPIs are also typically based on historical data. They're not forward-looking. In strategy, we're always looking forward, saying what is going to happen next. The few data points that we have that are based on forecasts or opinion polls are subject to lots of error. So as much as I think it's important to measure things, we have to be cognizant of all the challenges entailed in predicting the future based on the past. Metrics also don't take a long-term perspective. So, for example, if a company invests in a new factory, it might lower their return on assets because it's increasing their asset base, and maybe the factory is not online yet, so it's not increasing that return component. So we tie all these different aspects of metrics, the financial performance, marketing, operations, and the HR metrics together in a tool called the Balanced Scorecard. Financial metrics alone paint an incomplete picture. They really only address how shareholders see a firm. So the Balanced Scorecard asks, how do customers view a firm? And what business processes must we excel at? That's kind of the operations focus. What resources or talent do we need to invest in order to build the capabilities we will need for the future? That's those HR metrics. You tie them all together, and you should have a pretty good idea of how a company is performing. But be warned, there is a trade-off between simplicity and comprehensiveness.